These days, it seems as if when there is any financial news, it is bad news. And if you follow this channel, you already know the main financial narrative of these times. Inflation is raging in most countries of the world. Central banks all over the world are raising interest rates in order to fight inflation. Wall Street analysts are cracking down on unprofitable tech companies that basically are not growing anymore. So layoffs are sweeping the United States. As a result, consumers are not so confident in their job security. So they are pulling back on spending. Because of that, corporate marketers are cutting their ad spending. And ad spending is the lifeblood of tech companies. So, tech companies of all sizes are having layoffs. And on the narrative goes. But one unexpected bright spot just emerged. Banks seem to be reporting better earnings than expected. And raising their dividends. This video takes a closer look at the earnings of banks that have reported for Q3. What does this mean for interest rates? What does it mean for the US economy? And what does it mean for the future of the United States? But before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. JPMorgan Chase reported Q3 financial results that exceeded Wall Street expectations. As you probably already know, JPMorgan Chase is biggest U.S. bank as measured by assets. Rising rates were the key factor in enabling the bank to generate more interest income. Reviewing the key numbers. Earnings were $3.12 per share, exceeding Wall Street expectations of $2.88 per share. Revenue was $33.49 billion and that exceeded the expected amount of $32.1 billion. Q3 profit fell 17% as compared to $9.74 billion in Q3 of 2021. The bank also added to reserves for bad loans by $808 million. Revenue jumped 10% over 2021 to $33.49 billion for Q3. Generally speaking, banks earn more when interest rates are higher. And, since the Federal Reserve has aggressively raised interest rates, banks have benefited. Net income from interest increased 34% to $17.6 billion for Q3. This was mainly due to higher interest rates but also helped by an expanding book of loans. That exceeded Wall Street expectations by more than $600 million. Shares of JPMorgan Chase traded up 2.6% on the news. While consumer and businesses were financially robust in the period, the economic picture was darkening, said JPMorgan CEO Jamie Dimon. There are significant headwinds immediately in front of us, stubbornly high inflation leading to higher global interest rates, Dimon continued. The uncertain impacts of quantitative tightening, the war in Ukraine, which is increasing all geopolitical risks, and the fragile state of oil supply and prices, Dimon also said in the statement. While we are hoping for the best, we always remain vigilant and are prepared for bad outcomes, Dimon also noted. But Dimon also drew investors' attention to what he called headwinds that began appearing in the quarter. JP Morgan recorded $959 million in losses on securities after opting to sell treasuries and mortgage bonds to reposition its portfolio, the earnings call transcript said. Wall Street analysts are watching bank earnings very closely for signs of a slowing economy. If U.S. unemployment levels rise to 5% to 6%, the bank would probably have to bolster loan loss reserves by around $5 billion to $6 billion over a few quarters, Dimon said Friday in a conference call. JP Morgan, the biggest U.S. bank by assets, is watched closely for clues on how banks are navigating a confusing environment, said one Wall Street analyst. The job market appears to be staying strong. And, because of that, consumers and businesses seem to be repaying their loans. Profits for all banks are being helped by rising interest rates. And stock market volatility has been a tailwind to fixed income traders. Despite all of that, shares in big U.S. banks have not performed well at all. Shares in JP Morgan and other big banks are at our new 52-week lows. Investors are concerned that the Federal Reserve will inadvertently trigger a recession. Mortgage originations have fallen off a cliff. And investment banking deals have basically collapsed. Add to that, the weakening macroeconomic environment is leading banks to increase reserves for loan losses. The 6 biggest U.S. banks by assets are expected to set aside a combined $4.5 billion in reserves, according to analysts, continued the Wall Street analyst. I foresee a recession hitting the U.S. in the next 6 to 9 months, Dimon said in a cautious tone. Third-quarter investment banking revenue was headed for a decline of up to 50%, said JPMorgan President Daniel Pinto. This decline is largely due to the collapse in initial public offerings and new debt and equity issuance. On the positive side, trading revenue was up 5% jump from Q3 of 2021, largely due to strong fixed income activity. Shares of JP Morgan are down 31% from the start of 2022. That is significantly worse than the 25% decline in the KBW Bank Index. Morgan Stanley reported weaker results that did not meet Wall Street expectations. Management blamed sharp declines in revenue from investment banking and investment management. Wells Fargo Bank and Citigroup also reported mixed financial results. Bank of America will report Q3 results on Monday after trading hours. And Goldman Sachs has its Q3 earnings call set for Tuesday after markets close. Profits at U.S. Bank declined slightly in Q3. But U.S. Bank benefited from higher interest rates. Wells Fargo reported net income of $3.5 billion or 85 cents per share. That compares to Q3 2021 net income of $5.1 billion, which was $1.17 per share. For Wells Fargo, Q3 revenue was $19.5 billion, almost 10% than last year. U.S. Bank reported profit of $1.81 billion or $1.16 per share versus $2.03 billion and $1.30 per share in Q3. Wells Fargo is up nearly 5% at $44.35, while U.S. Bank is up more than 2% at $42.32. I would say that the bottom line overall is that, even though macroeconomic conditions are weakening, bank earnings are still okay. And, overall, big U.S. banks are navigating a rough economic patch reasonably well. Is the Federal Reserve actually causing deflation by raising interest rates while it says that it wants to fight inflation? ARK Fund's CEO Cathie Wood thinks that the Federal Reserve has actually crossed over the line by raising interest rates as far as it has. Wood thinks that the Federal Reserve is focusing on lagging indicators while the situation on the ground is changing quickly. Cathie Wood thinks that Federal Reserve Chairman Jerome Powell is making a huge mistake as he continues to raise interest rates. Wood says that Powell is on a path of outsized interest rate hikes to tame inflation, and it is a disaster in the making. Inflation is quickly turning into deflation, Wood said. That means the Fed will likely have to pivot away from its interest rate hikes sooner than the market thinks, Wood continued. The Fed should be focusing on real-time developments in the economy that show signs of deflation, Wood added. Leading inflation indicators like gold and copper are flagging the risk of deflation, said Wood. Even the oil price has dropped more than 35% from its peak, erasing most of the gain this year, she said in a tweet on Wednesday. Lumber prices are down more than 60%. Copper is down 30%. Then the Fed could find itself in a scenario where it over-tightened monetary policy and needs to pivot to prevent the economy from entering a hard downturn, continued Wood. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.